Let's go ahead and talk about investments in marketable securities. We're going to divide our investments into two basic categories. We're going to talk about debt investments and equity investments. Debt investments are investments in things like bonds, notes, bills, etc. We've already talked about the case where we were the issuer of bonds. Now we're in the position of being the buyer of these bonds. And we're also going to talk about equity investments, investments in common and preferred stock. Now, among our equity investments, we're going to further subdivide it into those cases where we own less than approximately 20% of the voting stock versus those cases where we own more than approximately 20% of the voting stock. This 20% threshold is supposed to differentiate those cases where we have significant influence over the investee. In those cases where we have significant influence, we're going to use the equity method, which we'll discuss later. And again, the 20% threshold is meant to capture, in the absence of any other information, the point at which you might be such a significant shareholder that you will have significant influence over the policies of the investee. Now, for our debt investments and for our equity investments, which are below the significant influence threshold, we're going to divide our investments into three portfolios. First, we have our trading portfolio. These are investments acquired for short-term trading profits. So you see the stock market sells off by a few hundred points. You say, this company's stock is undervalued. I'm going to buy a few thousand shares. When the price recovers, I'll sell them and pocket a quick gain. At the other extreme is our held-to-maturity portfolio. These are debt investments which we have the ability and the intent to hold until they mature. Now, this portfolio by definition can only apply to debt investments, since equity investments never mature. They exist as long as the corporation exists. The middle portfolio, the available for sale portfolio, is essentially everything else. It's everything which does not fit into the trading portfolio and does not fit into the held to maturity portfolio. So this would be any investments in equities which you plan on holding for anything other than a very short period of time. Now, we're going to be using fair value to account for some of our portfolios, the trading and the available for sale portfolios. And this was very exciting news, 10 years ago or a dozen years ago, because it was one of the first cases where we deviated from historical cost and actually used fair value. And the reason we're allowed to deviate from historical cost in this case is because we're presumed to have a readily available, verifiable measure of fair value. Again, the big virtue of historical cost is it's neutral and verifiable, it's not subjective. In the case of stock prices, if you own 1,000 shares of Ford Motor Company, you can look in the newspaper or look online and know exactly what Ford Motor Company is worth. It's not subjective at all. In the case of marketable securities, publicly traded, or securities for which there is an active market, we can simply use publicly available price quotes. The held-to-maturity portfolio is presented at amortized cost. First, the fair value of this portfolio is, in a sense, irrelevant because since we're going to hold these things to maturity, at maturity we will receive the face value, and so the intervening changes in fair value, while interesting, aren't ultimately going to be relevant. If the price of a bond goes up by 10% or down by 5%, that's interesting and it's relevant to us as an economic bit of information, but it's not going to affect the cash flows because we're going to hold this thing until it matures, at which point we get the face value. Amortized cost, since we will seldom if ever buy debt securities for exactly face value. Just as back when we were talking about bond issuance, we never issued bonds for exactly face value, or only in very rare and unusual circumstances. The same thing applies when we buy bonds. When we buy bonds, we will seldom, if ever, buy them for exactly face value. We'll either pay a discount or a premium when we acquire them. Let's go ahead and go through an example. Let's assume that on September 30th, 2014, we buy 1,000 shares of Ford Motor Company stock at $16.50 per share, plus a $10 commission. And this is going to be either a trading investment or an available for sale investment. Now, first and foremost, the $10 commission is not a separate expense. It's added to the cost of our investment. So the cost of our investment, we have the 1,000 shares of stock at $16.50 apiece, plus the $10 commission, for a total cost of $16,510. Now let's assume we have the following price quotes for Ford stock at the end of the next several years. 2014, it drops a little bit to $16 a share. 2015, it drops more, down to $15 per share. And then 2016, it recovers up to $18 per share. Let's go ahead and see how we account for the fair value aspect of this. Again, just a reminder, our initial cost is $16,510, and we have those given end-of-year values per share. At the end of 2014, again, the investment is on our balance sheet at its cost of $16,510. We want to report it at its fair value of $16,000, so we need to reduce it by $510. Now, we don't actually want to reduce the investment account itself. We don't want to lose that bit of information. So instead, we'll use a valuation account which will be presented right alongside the investment on the balance sheet. It will either add to or subtract from the cost to get to the fair value. So on our balance sheet, we'll have the investment at cost. We want to report it at its fair value of $16,000, so we need to reduce the investment by $510. And so we're going to create this valuation account called market value adjustment or something similarly appropriate. And in this case, it needs to have a $510 credit balance. It needs to be a credit balance since it's reducing the asset from the existing book value of $16,510 down to the desired value of $16,000. So to accomplish this, we're going to record an adjusting entry. We're going to go ahead and credit the market value adjustment, 510. That puts that valuation on the balance sheet. And this is an unrealized loss. Basically, our investment has suffered a decline in value. Is an unrealized loss or a paper loss or a holding loss. Essentially, it's a loss which has not yet been realized by selling the investment. At the end of the second year, we're going to compare the cost of our investment to the market value and determine the appropriate valuation balance in that market value adjustment account. So again, the cost is $16,510. The market value is $15,000. So we need a $1,510 valuation balance. And again, that's going to be a credit because it's going to reduce our asset from its reported cost of $16,510 down to its current market value of $15,000. Now there's already a $510 credit balance in the market value adjustment account, so we need to add an additional $1,000 credit. So again, we're going to credit the market value adjustment for $1,000, and again, basically our investment has suffered another decline in value of another $1,000. I can't recommend strongly enough that you use a T account to keep track of that market value adjustment account. At the end of the third year, we'll compare the cost of our investment to the market value again to determine the appropriate valuation balance in the market value adjustment account. Again, the cost is still $16,510. Market value is now up to $18,000, and so the valuation balance needs to be $1,490. And now it needs to be a debit balance since it is increasing our asset from cost up to the market value. Again, there's already a $1,510 credit balance in that market value adjustment account from last year. And again, I would strongly recommend you have a little T account going on a piece of scrap paper while you look at this. So to move from a $1,510 credit balance to a $1,490 debit balance, we need to debit that account for $3,000. So we debit the market value adjustment, and now we're crediting an unrealized gain on investments for $3,000. Again, basically, the shares of Ford stock have gone from being worth $15 per share to $18 per share. We've picked up $3 per share times 1,000 shares. We've got an unrealized gain of $3,000. And finally, about the trading versus the available for sale portfolios. Again, this was an equity investment, so it can't be held to maturity. It has to be either trading or available for sale. The mechanics of this mark-to-market process that we just went through are the same for each portfolio. The only difference is in where that unrealized gain or loss is reported. For our trading investments, the unrealized gain or loss is reported on the income statement down in the other revenues and gains, other expenses and losses section. Is treated just like a realized gain on investment as far as computing net income. For the available for sale investments, the unrealized gain or loss is reported as part of other comprehensive income. And so instead of being on the income statement and going to retained earnings, it's part of other comprehensive income and goes to accumulated other comprehensive income in the owner's equity section of the balance sheet.